Downgrade? What downgrade? Live from New York City this morning. Good morning, good morning. Your equity market just a little bit lower, negative by 0.6%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, the U.S. stripped of its AAA rating by Fitch, the White House scrambling to stem the political fallout as market participants line up to criticize the move. We begin with the big issue. Here we go again. More than a decade after S&P Global Ratings stripped the U.S. of its highest credit rating, Fitch making a move of its own. The rating downgrade of the United States reflects the expected fiscal deterioration, a high and growing general government debt burden, and the erosion of governance. Secretary Yellen pushing back, calling the move arbitrary, outdated, adding, quote, Fitch's decision does not change what Americans, investors and people all around the world already know, that Treasury securities remain the world's preeminent safe and liquid assets. Prominent economists elsewhere piling on the criticism. Mohamed El-Erian labeling the downgrade a strange move. Larry Summers said he can't imagine any serious analyst giving the decision any weight at all. And on Wall Street, a whole host of guests echoing that sentiment.
The Fitch rating downgrade came as a surprise.
A little bit surprising.
A bit of a head scratcher.
Clearly it's not good news.
It's never good when a rating agency says, okay, we don't like your debt as much as we used to.
I questioned Fitch across the board, and particularly the timing.
This comes at an economically sensitive time.
Politically, I think it is bad news for Biden.
The last thing that Yellen really needs.
From a market's perspective,
the market took it on quite well.
The initial market reaction, pretty moderate.
The whole response has been fairly muted.
The main question is, does this compromise the reserve currency status of the U.S. dollar?
There really is no viable alternative.
One never wants to forecast the demise of the dollar.
This probably doesn't really move the needle.
Doesn't seem to kind of create any market disruption.
In the long run, very, very little impact.
Your team coverage starts right now with Bloomberg's Anne-Marie in Washington, D.C., Mike McKee here in New York. AMH, walk us through the political fallout in the last 24 hours.
Well, we heard from the Treasury Secretary, and she's saying this is arbitrary. What we've seen from the Biden administration is they think this is baseless, and they really took issue, and they are criticizing Fitch for this. But they are pointing the finger to Trump, and they're saying this is MAGA Republicans who have done this. And this is also the likes of what we heard from Senator Chuck Schumer. He was saying it's the fact that Republicans flirted with the debt ceiling, and that is the fact that why Fitch had this downgrade. Now, on the other side of the aisle, Jonathan, you have the Republicans. The head of the House GOP campaign said that this has to do everything with Bidenomics. So obviously this is going to be the latest political punching bag in Washington, D.C. It is Fitch. And the fact of the matter is Democrats and Republicans are both going to point the finger that it was their party that is the fact that we have this downgrade. And Fitch is pointing to the deterioration in U.S. government standards in its announcement. So this is only going to get worse as we go towards the November 2024 election. The issue that Biden, of course, faces is that he is the sitting president during this downgrade.
Mike McKee, that's the political fallout. The market fallout, I have to say, pretty limited this morning.
Yeah, I think this deserves a quote from that famous economist William Shakespeare. Sound and fury signifying nothing. You take a look at the 2011 S&P downgrade and what happened after that. Well, there was a sharp move down the day they announced it and the Monday after. And then look what happened. The dollar went up. Stocks went up and bond yields went down. Everybody forgot about it, and it wasn't a big deal. Even though the deficit was a major political issue that year, it wasn't an issue for the markets. Now, the reason people are criticizing Fitch is that a year ago, Fitch upgraded the United States credit rating to stable and said there were three criteria under which they would downgrade the U.S. A significant or sustained rise in the debt to GDP ratio. That didn't happen. Deterioration in governance quality. Well, It's not particularly great, but they did get through the debt ceiling without a major fight. And then macro policy performance and prospects, well, those are much improved. The economy is growing strongly, inflation's coming down, and unemployment remains low. So why did they do this? Well, tune in later. We'll ask Fitch. But here's the biggest bottom line of it all, John, is you take a look at the term premium for the U.S. 2-year and 10-year notes, and it's still well below zero, still very negative. That tells you people are going to keep buying Treasury paper, even with the big issuance upgrade that we got this week. There seem to be a lot of people who want to own Treasuries, and as your guest Bob Michael said a little while ago, nobody buys Treasuries because of a ratings agency.
Very, very true. But Mike McKee, when the Treasury Secretary says arbitrary and outdated, it does come on the same day that the Treasury Secretary and the Treasury has to announce a much, much bigger refunding announcement than we had otherwise anticipated just several months ago.
Down the road, this could be a problem, but that is down the road, and Washington likes to kick the can. The issue is, when do you get to a point where the interest rates rise on the debt because people don't want to buy it? And it doesn't seem to be any signal that that's coming anytime soon. And they've got time to work on this if they so choose.
Mike McKee, thank you, sir. Alongside AMH, Anne-Marie will touch base with you in about 30 minutes' time on the latest drama elsewhere in Washington, D.C. Let's get to the panel. Invesco's Mo Hagbin, Krishna Mamani of Lafayette College. Krishna, we have to start with two questions. One, is it justified? And two, does it matter?
Well, so whether it is justified or not, I think on that front, the problem Fitch has is that they laid out the criteria so clearly, and everyone is going to pile on them for kind of not sticking to the criteria that they laid out. But if you kind of take a step back, if it was AAA before, and given what has happened over the last, let's say, 3, 4, 5 years, and given where things are going, is it totally unjustified? Probably not. Having said that, the likelihood that it has any impact on trading levels or the market, I think even in the short run, away from today or maybe tomorrow, I think the likelihood of any impact is pretty small at this moment.
Mo Hagbin, does it make a difference?
Hey, John. I mean, I agree with Krishna, absolutely. I think the bigger impact here is going to be politics and reputation. But from a market's perspective, we've already seen it. There hasn't been much of a reaction. You could argue a little bit in the equity market, but nothing in the bond market. We kind of saw this happen in 2011 as well. And, there was a short-term impact, but really it was kind of shrugged off by the market. So, there's no change in my view in terms of the relative attractiveness of yields and the kind of stable collateral that treasuries provide globally. It is kind of the basis of the financial system, and I don't see that changing anytime soon.
It's almost 12 years to the day, August 5th, 2011. Since then, the dollar's up by something like 40% on the dollar index, and U.S. assets have outperformed much of the world. The backdrop, Krishna, back in 2011 is so different to what we're experiencing now. Krishna, could you speak to that? The difference between what we were talking about with the general economy in 2011 and the kind of conversations we're having now?
Absolutely. I think, and to some extent, that is why, having laid out the criteria, the timing is so galling in some people's mind. And, the 2011, the outlook was extraordinarily bad. At that time, we were thinking that we will be in sub 1% growth environment forever. And for a while, that's where we ended up being. I think the economic outlook after the policy decisions, especially fiscal policy decisions coming out of COVID, have been extraordinarily good and extraordinarily effective. And the challenges that we are dealing with today is how to control inflation rather than dealing with a situation where growth outlook was going to be subpar for a very long period of time. And this is more of a solvable problem. So I think we are in a much better position today.
There are some numbers we need to talk about, though. The Treasury, 38 minutes ago, it's boosted the size of its quarterly sales and longer-term debt for the first time in 2.5 years. We learned yesterday, on the same day of this downgrade, that the Treasury Department needs to increase net borrowing estimates for the July through September quarter. So the one we're in right now, from 733 billion to 1 trillion. It was only back in May they were looking for 733. That's a big amount of money, Mo Hagbin. That additional supply, never mind the downgrade, let's take that additional supply, the fiscal deficit, what it's going to look like through the rest of this year. What does that mean for treasuries?
Yeah, so John, I mean, I think there's, to Krishna's earlier point, some justification. I mean, debt to GDP levels are elevated relative to other AAA countries, and I don't think there's any ignoring of that fact, right? So there is a problem in terms of debt. You know, I think what's really going to be the bigger driver, in my opinion, is relative yields and demand, and I don't see the demand for treasuries changing, at least in the short term. So from a market perspective, I stick to kind of what I said earlier. I don't see this being a huge kind of volatility event or any type of risk to the treasury market, but longer term, you know, it's something that we need to address, I think, as a nation. I mean, the debt levels are elevated, and relative to peers, it's something that we need to take note of.
Krishna, looking at yields right now, the 10-year up by 6 basis points. On a session, a curve steeper, the 30-year up by 4.16%. Spoke to a guest earlier this morning, Krishna. I wonder if this resonates with you. He said yields feel so high now because they've been so low over the last 10 years. But Krishna, if you could just erase the last 10 years, you looked at the fundamentals of the US economy, where the Fed is, where inflation is, where the labor market is, where growth is, where should the 10-year yield be?
So I think we have talked about this before. I think the direction of travel for yields, in my judgment, is higher rather than lower. I think expecting us to revisit the last 15 years from yield terms, I think will basically require a total change in direction with respect to fiscal policy, which, given the success of it, probably does not happen. So I think yields are probably going to be higher for an extended period of time than they have been over the last 15 years. Whether 4% is good enough, I don't think so. I think given the potential for reacceleration in the short run, I think the direction of travel is higher, closer to 4.5%, before we go down lower because things will slow down.
Mo Hagman, do you agree?
I do agree. From a positioning standpoint, we're also neutral duration. So we've added risk to the portfolio over the last month, but that's more on the equity and riskier credit side. The amount of kind of premium that investors expect, I think, is going to change, right? To Krishna's point, economic growth is coming in stronger than expected. The macro backdrop is much more favorable, and the demand for yield from clients is going to go up. So I think 4.5% is probably not the right number. We probably are going to be with a 5 handle, and that could be in the near term. It could also be something where the yield of the shape of the yield curve starts to renormalize, right? So we're kind of seeing the probability of rate cuts sometime in the second half of next year, but you could kind of see some renormalization of that yield curve.
Mo, Krishna, stick with us. Your bond market today, treasuries are softer. Yields are higher. Yields are higher not because of the downgrade that we got yesterday. Yields are higher because the data this morning was better than expected, and that additional supply coming out of the Treasury, which we'll discuss throughout this morning. Let's get you some movers going into the opening bell. Here's Abby.
Hey, John. Well, right now we're looking at U.S. futures heading to their worst day in almost a month. So some of the big draggers, not surprisingly, some of the heavyweight tech names, including Amazon. They report, of course, tomorrow. Nerves coming out ahead of that report. And actually, this is a little bit of a different board. So you can see that Advanced Micro Devices up 2.3%, decent quarter. CVS down 2.2%. The quarter was okay, but perhaps some folks are a little bit nervous about the job cuts that they're making. And then you can see there's Amazon down 0.9%, and they are, of course, reporting tomorrow. And 8.6% revenue growth, John, on a 57% year-to-date rally. Investors nervous. That happened to Microsoft last week, where they basically met estimates, but single-digit revenue growth not doing it. And then Starbucks off the lows, down 0.7%. Third quarter sales miss, and of course, there's a China concern there, John.
Abby, thank you. There's been a China concern through much of this year. Coming up, pushing out the recession calls or just ditching them altogether.
I'm more on the optimistic side. I think a softish landing is what's going to happen. Doesn't mean we won't have potentially negative GDP growth for a couple quarters, but kind of like early 2022, small negative, but with a resilient labor market, it won't feel like a recession.
Bank of America and Mike Apen, the latest to make a move. That conversation up next.
In terms of the last 20 years, I would say there has been an erosion in terms of the U.S. and our governance relative to other countries. It does cause people to stop and pause and ask these questions, which they should ask. There is an acknowledgement that debt matters, that you want to be sustainable. And the United States has had a soaring debt.
James Roberts here weighing in on Fitch's downgrade as the ratings agency doubts U.S. fiscal strength. Bank of America is upgrading its view on the economy and dropping its recession call. A team of economists led by Michael Gapin saying this: recent incoming data has made us reassess our prior view that a mild recession in 2024 is the most likely outcome. Growth in economic activity over the past 3 quarters has averaged 2.3%. The unemployment rate has remained near all-time lows, and wage and price pressures are moving in the right direction. Mo Hagbin, Krishna Mamani back with us. Mo Hagbin, there's another one. Dropping the recession call or pushing it out. I've seen this time and time again over the last several weeks. I'm sure you have over the last several months. Mo, you are constructive on risk assets. How much of it is about this elusive nirvana that people think maybe can materialize, a soft landing?
Yeah, unfortunately, I'm not going to be a contrarian on this point. So we tend to be in the same camp. We're a bit more on the optimistic side, and we see, leading economic indicators and sentiment suggesting that, we will continue to see some strength in the global economy. Now, we don't know if there's going to be a little bit of a soft patch. I think we are kind of in that soft landing camp. That doesn't mean this is the beginning of a new cycle, but in the short term, from a tactical perspective, we are adding risk to the portfolio because we do see growth expectations being repriced by the market. And we do see riskier parts of the market outperforming more defensive and safer parts of the market. So in the near term, we like risk assets. We like equities and riskier credit over bonds.
Can you be bullish disinflation, Krishna, and constructive on earnings?
Well, so I think that's an interesting question. To kind of reposition slightly from what Mo was saying, I think at the moment, the likelihood of a recession is pretty small. And I think that is getting pushed out. The real question is, are we going to get into a reacceleration? And reacceleration, as you say, is going to be very good for earnings, but it is going to be very bad for the mood that the Federal Reserve gets into. And if we do have a reacceleration, then they will come back at the economy much harder than they have done so far. And I think that gets us a recession rather than just the status quo and how things are moving right now.
So, Mo, have we got to stay in this sweet spot of OK growth and further signs of disinflation? Any sign of a pickup, would that make you nervous?
I don't think a little bit of a pickup is going to make me nervous. I actually kind of expect it. I do think even if we have a little bit more tightening in the system, it's really just, we're talking about 25 basis points, right? So just given the magnitude of tightening, we're at kind of 5.5% at a very short period of time, at 20 plus year highs. I don't see that really being meaningfully, it's not going to have a major impact on risk assets, in my opinion. We've kind of looked at the end, or we're looking at the end of a tightening cycle. Now, if it's a meaningful reacceleration, to Krishna's point, then you could see, a little bit of a, hawkish stance that could also be very negative for risk assets. I don't expect that, though. I expect things to be kind of in that Goldilocks environment, at least for the next couple of quarters.
Well, let's go through it piece by piece. Stocks are up, credit spreads are tighter, the dollar's weakened since the end of last September. The current tightness of the labour market, Mo, people agree, Mo, you'd agree, I'm sure, is inconsistent with inflation returning back to 2% anytime soon. Bill Dudley, the former New York Fed president, made all of these points in an opinion column yesterday, and you haven't read it, I suggest you do, because even if you disagree with it, it's thought-provoking. This quote, Krishna, from him: there's considerable evidence that the lags have shortened, he said, meaning that the economy has already felt nearly all of the impact of the Fed's actions. Krishna, this is where we're at right now. You can make the argument that the lags are super long and they haven't hit yet, or you can make the argument they're super short and we've already seen them, Krishna. Which one is it?
Well, so I think the issue is the lags are dependent on the structure of the economy. And what we are finding out is the structure of the economy, because of all the low level of rates that we had experienced over an extended period of time, has become far less income Fed funds rate sensitive. And that's a challenge for the Fed. And I don't think the Fed has been able to slow down the cyclical part of the economy. And that is something that they will have to deal with if that part of the economy reaccelerates. And housing is probably the best example of that. So I think it's, instead of talking in terms of lags, we should be talking in terms of interest rate sensitivity of the economy and what impact policy decisions are having on the cyclical part of the economy.
ADP this morning, 324. Payrolls on Friday, 200K. How many more months of that, Mo, would we need for this Fed to sit here and say, maybe we need to go and do some more?
Yeah, look, so I think we're very data dependent. We have, two unemployment numbers or jobs reports, and we have two kind of inflation prints that are kind of in between the next meeting. You know, I think, we're probably going to surprise to the upside, but not enough for there to be like a meaningful change in some of the rhetoric that we've heard already. We're towards the end of the tightening cycle, right? And whether it's another 25 basis points or not, I don't really see a material change in stance. I do think, and to Krishna's point, we haven't seen necessarily all of the lagged effects, right? So we have to give it a little bit more time. We haven't been in this period of tightening for very long. You kind of think about this last 2 years, it's a very, very tight policy stance in a very short period of time. I am not in the camp that all of that has trickled its way into the real economy.
Mo, the world's coming in your direction, constructive, increasingly so since the last time we spoke. Mo Hagbin is going to catch up alongside Krishna Bamani. The broader market at the moment, equities negative on both the S&P and the Nasdaq going into the opening bell about 7 or 8 minutes away. In the Treasury market, softer, yields up at the longer end, on a 10-year up by 5 basis points, on a 30-year up by 6 basis points. This move, though, nothing really to do with the downgrade from Fitch and everything to do with two things. The data, better than expected from ADP that everyone says they don't care about until, of course, they do. And it comes out with a big upside surprise like it did this morning. And on top of that, the Treasury refunding announcement. We got a teaser of that just yesterday, pushing yields higher, the curve steeper. So that's the bond market. In foreign exchange at the moment, the euro negative by about 0.2%. The dollar stronger there at 109.67. Up next, the morning calls, and later, Lori Calvasina of RBC joins us around the opening bell to weigh in on the market impact of Fitch's US downgrade and look ahead to big tech earnings later this week. 4 minutes away from the opening bout, just a touch of risk aversion here. We're negative by 0.7% on the S&P, on the Nasdaq lower by almost 1 full percentage point. That's the price action. Here's some morning calls. First up, Susquehanna downgrading Norwegian Cruise Line to neutral, saying the liner is still in the early to middle innings of its turnaround. We're down there by 3.4%. Wolf Research upgrading Charter to outperform. The analysts seeing fiber pressure peaking and positive free cash flow. And finally, Deutsche Bank upgrading SiriusXM to hold, predicting that the second half of the year will be better than the first, following the company's Q2 earnings report. That stock is positive by 1.2%. Up next, RBC's Lori Calvasina on the potential market fallout from the Fitch downgrade, with results from Apple and Amazon just around the corner. Live from New York, your opening bell. Up next. Here we go, about 20 seconds away from the opening bow. The session just around the corner. Equity futures down by 0.75% on the S&P. On the Nasdaq 100 down about 1 full percentage point. A bit of risk aversion at the moment in the equity market, disconnected to some extent from that downgrade from Fitch just yesterday. There is a move in the bond market, but the move in the bond market is about something else. That's your opening bow. Switch to the board and get to the bond market. Treasury yields this morning higher by 6 basis points. The economic data better than expected. Another upside surprise from the ADP report going into payrolls on Friday. And then some Treasury issuance. You're going to get a ton more supply than we thought we'd get from the Treasury this quarter. We'll touch on that a little bit more throughout the day on Bloomberg TV and radio. Yields up, dollar stronger, euro down, negative by 0.2%, 109.65 on that currency pair. And crude just edging just a little bit lower, down negative by 0.25% at $81 and about 20 cents. 25 seconds into the session, call it 30. We're negative by 0.7% on the S&P. The Nasdaq lighter, negative by about 1% at the moment. The Treasury is boosting the size of its quarterly debt sale for the first time in over 2 years. That bump in issuance showcasing the rising borrowing needs that prompted Fitch to lower its U.S. credit rating. Shanali has more on the fallout from that. Hey, Shanali.
John, I don't think you could do this without first talking about what's happening along the curve when you look at the treasuries right now that are trading. If you take a look at the 2-year, you are watching it fluctuate all morning on the back of that downgrade yesterday. Not a real impact over there on the short term. But when you look at the long term here, on the back of the funding announcements as well, remember these are 3, 10, and 30-year treasuries that are being sold. These sizes of sales are the first we've seen in years, and you're seeing more movement at the 30-year, which I think is more interesting. It's hovering at about 416, 417. So I think the longer term ramifications of both this downgrade as well as what you're seeing in the deluge of issuance that we're going to see in the coming weeks are interesting. Now, let's talk about the downgrade itself, because even though the market is shunning it completely or shunning it to a large degree, saying it doesn't really matter for the long term, America is the best game in town, you do have to think about the ramifications for the market in the short term and the long term as well. Money market funds now are holding things that they have told investors are worth something else in terms of the rating. You also have to think about the credibility issue here when you think about what it means for investors to be saying, well, what Fitch says here doesn't really matter. Does that change the appetite around risk moving forward? Then there is the pressure on treasuries overall. And in a higher interest rate environment where liquidity is harder to come by, are there going to be more funding issues moving forward? We have seen the debt capital markets open back up for companies. Does a move like this start to put a wrench in that? And do the repo markets start to face some hiccups moving forward? That's what we'll be watching out for.
Some crowding out potentially. Shanali, thank you for that. Just breaking down some of the issues at play here. Into the open and bound and out the other side, we're negative by about 0.8% on the S&P. Want to get into some single names for you just briefly. CVS, the drugstore chain, beating estimates for quarterly profit and sales. Its CEO saying this: we continue to execute on our strategy to expand access to health services across our care delivery channels and strengthen our consumer engagement to improve their health and well-being. Abby has more. Hey, Abby.
Hey, John, and that is all true, and yet the stock is down more than 1%. All over the map, though, this morning. Earlier in the pre-market on these results, it had been up 2%, down as much as 2%. So first, for the good news, what you were just talking about, they beat on the surface level. Prescriptions filled was a positive. The revenue grew 7.6% to nearly $29 billion. The insurance medical benefit ratio grew to 86.2%. The bad news, though, John, next year and the year after, for 2024, they're saying they can no longer meet their guidance of $9 per share, earnings per share. And for 2025, they can no longer meet $10 of earnings per share. So that is weighing on the stock. And of course, yesterday they announced that they are doing this restructuring, cutting 5,000 jobs, more so at the corporate level. They're trying to transform into more of a healthcare company from the retail. On the year, John, CVS down more than 20%. Underperforming the S&P 500 essentially by 40%. This company really has their work cut out for them.
Brutal. Down again this morning by, let's call it 0.8%. Abby, thank you. Different outcome for Starbucks. The coffee chain's third quarter comparable sales missing estimates. The CEO saying this: while we continue to navigate an environment with a heightened level of macro uncertainty around the world, we will execute with discipline and rigor on our priorities. Katie has more. Hey, Katie.
Hey, John. Yeah, record revenue for Starbucks, but falling sales. As you mentioned, comp sales rose about 10% in the quarter. That was below analyst estimates of just about 11%. Meanwhile, adjusted EPS, it did come in at $1. That is better than the average estimate of 95 cents. And revenue, it came in at $9.2 billion. That's just short of estimates, but it's a record nonetheless. And that's thanks to higher prices and beverage add-ons over at Starbucks. So there's some good news in these numbers, but overshadowed by that disappointing comp sales print. And you look at the Wall Street reaction so far, the sell side unimpressed by the report. Jeffrey's writing that the quarter was, quote, slightly underwhelming. And you can see that in the shares as well. Starbucks currently down about 0.5% or so.
Katie, thanks for that. Appreciate it. Let's turn to AMD just briefly, topping second quarter estimates and promoting advancements in AI. The CEO saying this: while we are still in the very early days of the new era of AI, it is clear that it represents a multi-billion-dollar growth opportunity for the company. Ed has more. Morning, Ed.
Yeah, good morning, Jonathan. That opportunity, $150 billion by 2027 for the market for AI accelerators. The gain in AMD short-lived, now down 0.8%. We had opened higher, and as you saw in aftermarket trading last night, we're up by almost 4%. The market's changed its mind on something. Customer engagements increased 7x on AMD's AI products in the quarter, but that is not akin to tangible sales. Those will come later in the year, and next generation AI accelerator products coming in the final 3 months of this year. A slight beat on the top and bottom line in the quarter just gone, but year-on-year negative growth on the top line, which is important. You then go to the forecast for the current period. Interesting, because at the midpoint of that forecast, it would represent top-line growth of 2.5% if they hit it, meaning that they would end 2 sequential quarters of top-line decline. The story really similar with AMD to what we saw with Intel. PC market seems to be recovering, but the data center business slower to recover, though Lisa Su, AMD CEO, said we would see that recovery start in the second half of this year. How often have we heard that?
The stock is negative by 0.7%. Ed, thanks for that. Big day for Bloomberg Technology tomorrow, of course. Ed Ludlow, Caroline Hyde. After the close tomorrow, we're going to hear from Apple and Amazon. Those two names, the NASDAQ 100, they make up about 17% of it. So a big chunk, big slice, big weighting of that particular index. For the broader market at the moment, we're down by 0.9% on the S&P. On the NASDAQ, we're negative by 1.3%. In the Treasury market, we're down there too. Yields are higher, particularly at the long end. On a 10-year by 5 basis points, on a 30-year by 7. So much feedback this morning, and honestly, keep it coming on the debt downgrade. This came from Pendle Group over in Sydney. What would replace Treasuries? And they go through things piece by piece. Euro govies, here's the quote. That's still a currency breakup accident waiting to happen because of the lack of fiscal unity. China, nobody wants that sovereign risk. Japan, the BOJ still owns half the market. That's the privileged position this Treasury market still is in the minds of so many people out there responding to that downgrade yesterday, that there's nothing out there right now to replace it. Lori Calvasina of RBC Capital Markets weighing in with her own view and saying this: I'm probably not too different from everyone else who was surprised to see this, especially given that markets were relatively well behaved during the debt ceiling drama. This is coming at a time when the stock market has been successfully climbing a wall of worry, but sentiment is starting to approach concerning territory. Laurie, I'm pleased to say, joins us now for more. Laurie, I've asked everyone this question. You get the chance now. How did you respond to that yesterday?
I think like everyone else, I scratched my head a bit and said, really now? And oh, by the way, we've got 150 companies in the S&P 500 reporting earnings this week. So I find, all the reactions that are coming through, John, really, really interesting. People seem both puzzled and annoyed, at the timing of this. And I think, I certainly am scratching my head like everyone else, but we've got a lot of other stuff to get through this week. So I think people are going to take a beat, try to give this some thought and not overreact in the short term.
Let's touch on the other stuff. I'm confused by the earnings, and it's always my issue with earnings season, Laurie, that you can pick a single name and tell whatever story you want to tell. JetBlue is saying that the domestic story is not as good as you think it is, and Caterpillar's telling me the international story is not as bad as I think it is. Which one is it?
So, John, on my team, we divide up the sectors and we try to read through as much of this stuff as we can. And I will give you the caveat. I have not read anything that's come out this week. We do lag a little bit. There are 3 of us. But the reality is that I do think the international commentary that I have seen, whether it's been about Europe or China, does feel like it's tilting negative. And that's something, very different, I would say, from past reporting seasons when it felt, a little more positive and then a little more mixed. And now I feel like everything I'm reading is more on the negative side. So we know obviously not every company is saying that, but that's really where I see the bias right now. I do think the consumer conversation, is still pretty similar to what we've seen in the past. I have noticed some mixed, sort of commentary from some of the airlines. I'm not going to deny that, but I do think in general, the consumer is still described as very healthy, very resilient. I think that story hasn't changed. Outlooks, though, very mixed. I was complaining to my team the other day. I just feel like I'm not getting a whole lot of meat on the outlooks. There's just not a lot of discussion, and that's leaving me feeling pretty annoyed, frankly.
You're not the only one. I'm not sure what they can offer us because everyone's been so confused by the year so far, Laurie. When you listen to those calls at the moment, you go through that communication with the rest of the team. Are you seeing continued consumer price tolerance? Are you seeing a loss of pricing power? Is it anything like that from one sector to the other? Is it a broad story or different?
So what I am seeing in terms of the consumer companies is that, and consumer related companies, right? Because we've got a lot of companies that have reported so far that aren't technically consumer, but are sort of in related areas. What I'm seeing is commentary about a choosier and pickier consumer. So consumers who are starting to push back a bit. Also, I've been fascinated on the pricing discussion. Generally, the commentary around things like pricing, inflation, kind of all of the opportunities and headwinds from 2022, that level of conversation is all going down very rapidly, so we're just not getting as much of it as we were. But on the pricing discussion in particular, I'm seeing softer discussions. It used to be like, hey, pricing is really strong. We're going to go out, we're going to pass it through, we're going to keep it going. We've got the ability to do that because of the cost environment. Now what I've noticed is that a number of companies in different industries are saying things like, well, the cost environment is getting better. Inflation is coming down. Pricing, we're still kind of lapping the benefits of past pricing, but pricing is going to moderate as inflation moderates. So I do think the tone on pricing has changed dramatically from what we've seen over the past year or so.
So Laurie, build on that. How can one make the argument right now to be in the more cyclical parts of the equity market at a time when maybe we're witnessing the beginning of a loss of pricing power?
So I think it's a great question. And I do think we have to, sort of separate out some of the different issues. I do think if you go back to last year, whether or not we end up getting a recession this year, is up for debate. Regardless, we paid for it last year. And if you look at how the market's been acting since that October low, we're starting to see signs of small caps doing a little bit better. We're starting to see signs of lower quality, smaller cap stocks doing a little bit better, even within the Russell 1000. This market is acting like we're in a recovery trade, like we already had a recession, like we priced it in, and that we're pricing in that recovery now. So I think the continuation of that tailwind is what gives some of these cyclical sectors life, because a lot of this stuff that we're starting to go through has frankly already been priced into markets. I do think, though, that when you think about the earnings trajectory for next year, and that's maybe a different question from, kind of what we're navigating for 2023 itself, I do think you have to temper your expectations on earnings a bit, because as pricing comes down, that is going to be a hit on revenues. Now, that doesn't mean it has to be a disaster for the market. I can still come up with a pretty robust scenario for markets next year with lower than expected earnings. You'll get some benefit on the multiple as inflation comes down. But I do think people really need to start thinking about that idea that as inflation moderates, you lose some of the benefits that have come from that inflation for companies, and earnings expectations may need to be tempered a bit.
12 minutes into the session, we are negative by 0.8% on the S&P 500, on the Nasdaq down by about 1.3%. Laurie, as you basically warned to temper the enthusiasm just a touch, I think one area where you stand out is your commitment still to core holdings in technology over a time horizon longer than 5 minutes. Laurie, why is that still important?
So, we really think about this concept of recovery. I'm not fighting yesterday's recession battle the way some strategists are, right? I'm thinking about the recovery. I do think the market's already priced in a lot of recovery for next year, but we really want to think about what kind of recovery are we going to have in 2024 and 2025. And the GDP stats are still coming in pretty sluggish at 2% or lower. And in a 2% or lower real GDP world, growth stocks typically outperform. And I'm not saying you have to go all in on growth right now. I do think some of those stocks are extended. The valuations don't look great. But if we're wanting to really think about the long term, if we do see some weakness in some of those tech parts of the market, I think you want to add to them. I would be very selective, stick with the higher quality industries like software. But secular growth typically works best in a sluggish economic backdrop. And I do think that sluggish economic backdrop is what is the price we pay for perhaps skipping a recession or only having a mild one this year.
Laurie, thank you for an update. Laurie Calvasina there of RBC on this equity market. Brilliant as always, with her view on where things are going. 14 minutes into the session, this is where we're going right now. Down by 0.7% on the S&P, the Nasdaq lower by more than 1 full percentage point. Coming up on this program, what a day in Washington, D.C.
Fitch is older than the debt ceiling law. Whatever else is going on here, I think there's a motivation that's a little less pure than a lot of people would want to talk about.
Fallout from Fitch's US downgrade and Trump indicted once again. That conversation up next.
Fitch is older than the debt ceiling law. They were founded 3 years before the first debt ceiling law happened. And, now they're bestirring themselves to complain about the process through which the United States appropriates money and deals with its debt. So, whatever else is going on here, I think there's a motivation that's a little less pure than a lot of people would want to talk about.
Fitch's downgrade sparking criticism almost across the board, including from the White House Press Secretary Karine Jean-Pierre, writing this: "We strongly disagree with this decision. It defies reality to downgrade the United States at a moment when President Biden has delivered the strongest recovery of any major economy in the world." As if all of that wasn't enough drama, that decision came just moments before this.
Today, an indictment was unsealed, charging Donald J. Trump with conspiring to defraud the United States, conspiring to disenfranchise voters, and conspiring and attempting to obstruct an official proceeding.
Let's get to the team coverage. Bloomberg's Anne-Marie back with us alongside Kelly Lyons in Washington, D.C. Morning, Kaylee.
Good morning, John. This is the third indictment of former President Trump, as the special counsel Jack Smith was laying out there. 4 different charges here, including conspiracy to defraud the U.S. and conspiracy against rights, which is the right to vote and to have one's vote counted. Now, this indictment also named did not name 6 other co-conspirators, though it did say that they exist. They were not charged, just the former president. And these charges could carry upwards close to 20 years in prison if convicted. Now, as for what happens next, Trump has been ordered to report to the magistrate judge at the federal courthouse here in Washington tomorrow, August 3rd at 4 p.m. Eastern time. And Jack Smith said in his remarks last night that he will seek a speedy trial. It is important to note here, though, John, Trump already is preparing for other trials and other indictments he has faced. He was indicted in Florida in the classified documents case, 40 counts of criminal charges there. That trial currently set for May of next year. He also was indicted in the state of New York related to hush money payments made to porn star Stormy Daniels. That trial is set for March. Plus, we could see another state indictment coming down later this month. The district attorney in Fulton County, Georgia, has long said she would bring charges into the investigation into efforts to overturn the 2020 election in that state before September. So the legal battles and the legal bills are stacking up for this president, John. A lot of this will be coming during primary season when the former president will be actively campaigning to seek re-election in the Republican nomination. And he is bleeding money. The super PACs that are supporting him, as well as his campaign, yes, have raised millions of dollars, but they've spent tens of millions of dollars in legal fees already, and those bills are only posed to get higher. I would note in regard to the campaign, John, they did put out a statement in response to this indictment last night saying this is the latest corrupt chapter in trying to interfere with the 2024 presidential election.
Anne-Marie, losing money. Is he losing voters?
Oh, John, definitely not at the money. He is, when it comes to voters, in the latest national poll, Siena, New York Times, what you see there is Trump is at 54%. DeSantis, who's the number 2 in this poll, and he is his closest rival at the moment, is only at 17%. And what we've seen time and time again from the former president is that every time he's indicted, he actually surges in the polls, and not just in polls. He also brings in campaign donations that Kaylee just mentioned. And as those indictments help him bring more campaign money in, that campaign money then, Jonathan, has been used, more than $40 million worth, to fight these legal fees for him and his close associates. So even though these charges, the gravity of these charges are so serious, conspiracy to defraud the United States, conspiracy to not have an individual's vote counted, these are the most serious charges we have ever seen against the former president. As Kaylee mentioned, this is only the 3rd indictment, and it is definitely a serious one. But at the same time, it is not hurting him at all with the Republican base.
AMH, thank you. Alongside Kelly Lyons, looking forward to the programme. Balance of Power a little bit later on today, 5 p.m. Eastern Time. No doubt that's going to be a top headline for them and the team down in Washington, D.C. The broader story in the market at the moment, let's call it 22 minutes into the session, we are pulling back by 0.8% on the S&P 500. On the NASDAQ, down a little bit more than that. Let's lift the lid on the index, get you some sector price action. Here's Abby.
Yeah, John, we are looking at the worst decline for the S&P 500 in about 2 weeks, so not surprising surprisingly, most sectors are down. The breadth that we had seen to the upside, well, it's now moving to the downside. Up top, though, healthcare up just slightly, consumer staples and utilities up just slightly. That makes the day a little bit more risk off. Those are defensive sectors. On bottom, it's all about the big tech sectors down more than 1%. Let's dig into that just a little bit more, because from the peak last week, this sector, the S&P 500 tech sector, now down about 3%. Microsoft was one of the big tech stocks to close down in the month of July, a bit of an anomaly, but you have to wonder, is this the beginning of a little bit of cooling, at least for big tech?
Abby, thank you. Stock softer. Your trading diary up next. It's pretty defensive stuff so far. 25 minutes into the session, outperforming staples, healthcare, utilities, everything else in negative territory, led by a decline in tech. The Nasdaq down by about 1.4% at the moment. That's the price action. Here's the trading diary, the events you need to be looking for through the trading day. Qualcomm, those earnings coming after the closing bell, ahead of Apple and Amazon after the close tomorrow. Another round of jobless claims tomorrow morning, plus durable goods orders too, and a Bank of England rate decision as well. Then we round things out this coming Friday. Friday just around the corner, a couple of days away. Payrolls. The payrolls report, the estimate at the moment about 200K. 200K after a decent upside surprise on the ADP report a little bit earlier. Stacked lineup on Friday, worth repeating once again. Mohammed Al-Erin alongside Rick Reeder, Michael Collins and Anastasia Amoroso. From New York City, that does it for me. Thank you for choosing Bloomberg TV and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.